So today we're going to talk about inventory costing methods. And as you read in the chapter, you saw that there are four. There's specific identification or specific unit method. That's for inventory items that are very easy to identify and very easy to determine what the cost of goods sold would be, like a car, a building, a grandfather clock, something that it's easy to determine what the cost of goods sold is. When it comes to items that are identical to each other or very similar to each other, that becomes difficult to do. So three other methods have been developed. We have FIFO, first in, first out. We have LIFO, last in, first out. And we have the average cost method. Let's take a look at an example and see if we can take information and figure out what our cost of goods sold would be under each of those three methods. So this example here, where we have beginning inventory plus a variety of purchases, again, is not designed to be realistic. It's designed to make a point. In other words, to show the difference between the three methods. Okay, so the first thing we want to do is we want to add up the quantity. So we have 123. That's the units available. Over here, okay, we can see that beginning inventory was 22 and 14, giving us a total of 308. There was a purchase on April 4th of 29 at $15 a piece, giving us 435, etc. So if we total all of these up, that gives us what's called the cost of goods available for sale. Okay. There's a formula that I put down here that can help us maybe understand some of this a little bit better. If we take our beginning inventory plus our purchases, that gives us cost of goods available for sale. And that's what we've done up here. We've taken our beginning inventory plus our purchases. So we know the cost of goods available for sale, but remember, this is our cost. Okay? If we're the company that is selling items, this is our cost. So we have sold 103 of these units at $30 each. So that gives us a sales revenue of $3,090. That's the retail price. That's what we're charging our customers. And for the purposes of this exercise, we're simply assuming we sold them all at the end of the month. Okay? Again, just to highlight the differences between the methods. So the first method we're going to look at is FIFO, first in, first out. So we know that we have 123 units available. We know that we sold 103. So we know that there's we know that there's 20 in ending inventory. Okay, again, we have 123 available. We sold 103. We know that there's 20 left in ending inventory. So what I would suggest we do is just copy this all down. So that way we don't have to redo formulas. So let's copy this down to here. Okay. And then we can add these up. Okay, now, we already said that we only sold 103, which means 20 have to be in ending inventory. The question is, which 20? Well, if it's FIFO, it's first in, first out. It means that we must have sold the first ones we had, the beginning inventory and the purchases through April 18th. So the 20 in ending inventory have to be part of the April 29th purchase. So if I have 20 in ending inventory and I purchased 33, that must mean that I sold 13 of those from April 29th. So we're going to change this to 13. And that's going to give us a cost of goods sold under FIFO of $1694.50. Now, getting back to the ending inventory, we know that they come from this purchase. So we know that our ending inventory has to consist of 20 items at $20 each, right? So that's going to be $400 in ending inventory. Now, when we look back at this formula, we can see that beginning inventory plus purchases equals cost of goods available for sale, as we said, minus ending inventory gives us cost of goods sold. So if cost of goods available for sale minus ending inventory gives us cost of goods sold, it only stands to reason that cost of goods sold plus ending inventory would equal cost of goods available for sale. So these two together should equal this. So we should verify that. And yes, it does. So we could be confident in our numbers. So our cost of goods sold under FIFO is $1694.50. Now, when it comes to the income statement, okay, you would have to know what the operating expenses are, and we're just kind of grouping them together as one thing to make it a little bit easier, because our focus is on the gross profit. So sales, we already calculated up here, is $3,090. Cost of goods sold under FIFO, okay, we calculated at $1694.50. We remember we learned in chapter 5 that sales minus cost of goods sold is gross profit. So under FIFO, we have gross profit of $1395.50. Now, if we look at our operating expenses, again, those have to be given to you. There's no way you would know that. But what we would need to do to get net income is to take our gross profit minus our operating expenses. If we take our gross profit and we subtract our operating expenses, which are at C37, we're going to get a net income of $595.50. Now, it's going to be different under LIFO and under average cost. When prices are rising, cost of goods sold will always be lower under FIFO and gross profit higher because we're selling the older, less expensive goods first. So our gross profit percentage, and we also went over this in chapter 5, right, is going to be our gross profit divided by our sales. So under FIFO, it's 45%. So in the next video, we'll look at LIFO. Thank you for your attention.